So about 2 weeks ago, we sent out our RIDS report, and the question on the report, or the title of the report, was, "Is the bottom in?" And we thought we were close. And sure enough, the next market day opened up and the market went higher. So, so was the bottom in, or do we have a little bit more to go?
Well, I think we'll find out. Historically, your strongest months begin in December. So we still have probably a couple of weeks where it could be a little bit iffy. And ideally, if we had our choice, we'd like to see the market just soften just a little bit, provide us some investment opportunities at a better price point, and then be able to take advantage of what historically is a strong end of the year, first part of next year. The odds of that happening are pretty good. I think someplace in the ballpark of 85%. So we're kind of in the position right now where we're trying to pick where we think will be the best investment opportunities over the next 6 months or more.
Yeah, I mean, I think that that's a good point, because the market's been pretty muddling all year long. You had the S&P 500 has really been led by 7 stocks. In March, we had the bank failures, and the market really shifted. So those 7 stocks did well, but the other 493 stocks are actually negative for the year. And the overall equal weighted market, S&P 500, is negative year to date. I think that might surprise people.
Yeah, I think that's true. I think when people think about an index, they never think about what's inside the index, right? So to your point. So last year, we had a really bad year. Things were down significantly. This year, the things that misleaded people the most is your point about 8 stocks led the market. If you look at the equal weighted index, like you mentioned, small caps, mid caps, they are all underwater this year, so far this year. And so far this year means halfway through November.
I know.
So for all intents and purposes, we've had what would be a down year in the market that was masked, if you will, by 8 names. The problem with that is that if you say, well, why don't we just invest in those 8 names? From my standpoint, what happens is that you change your risk profile dramatically. And as money managers, probably our principal responsibility is to make sure that the risk profile of our clients is appropriate to the client, but even more so from a historical standpoint, most appropriate. So taking all the money that people having loaded in 8 stocks, roll the dice and keep your fingers crossed is not really a very good management technique.
Yeah, and certainly not, given that the money we're managing is our clients' important money, the money they really can't afford to lose. So while we've had exposure to those 8 stocks within the portfolios that we're managing, we didn't go all in only 8 stocks, right? So, and it's probably not, something to think about even when you think back to you were investing in the 60s and 70s with the Nifty 50.
Yeah, I think back, because this year sort of reminded me of what we were doing back then. If you look at those stocks that were the greatest stocks of all time, the Nifty 50, and you look at them today, half of them or more have disappeared from sight. Mm-hmm. So if you think, oh, I'll just throw money at it and I'll forget about it, it doesn't work. Over time, I've always been a big believer in diversification. If you think about our typical portfolio, we diversify between fixed income, equity, right now we have a hurdle rate in fixed income of somewhere in the ballpark of 5%. So when you're looking at your portfolio, your total portfolio, one of the things you always keep your eye out for is how diversified am I? Is all of my money working in places that is sensible and well protected and well managed? So I think that's one of the things this year that's probably been overlooked. You know, when you watch the results on TV, you have to remember that one of the things you're looking at is entertainment.
Right.
And there's a whole lot of difference between entertainment and strong money management. Strong money management is much more conservative.
Yeah.
And so for us, one of the most important things we try to do is make sure we don't lose the money that you already have.
Yeah, I think that that's a really key point. And our portfolios have really significantly outperformed the markets this year. But you know, we just had this conversation in the investment meeting. We just walked out of it. There is a ton of cash sitting on the sidelines, both with individual investors putting money in the money market and institutions who are being a bit more cautious. And if the market gets into gear going into year end, watch out. We are going to have a strong run. And so that's really what we're keying on and what we're watching for.
Yes, I think that's exactly right. I think that in this business, you know, it's largely about statistical probability, right? And if you said to me, well, okay, you've got an 85% chance of being right, boy, that's not bad.
Yeah.
You know, I'll take that. So,
exactly.
So what we're looking at is a period that should, at least historically, present us with a strong market as we move into 2024. Hopefully 24 will be a better year than 22 and 23.
Great. Well, I think we did pretty good for drawing the short straws in today's video, but there's a lot of good information and we're looking forward to, you know, making a lot of money into year end and 2024.
That'd be great.
Yep.
Never too late.
Absolutely. Okay, thanks.
Right.